Hi, welcome to a special episode on cryptocurrencies. So we have witnessed a dramatic crash in a number of cryptocurrencies recently. Luna and Terra USD, some of the stable coins in the crypto world, have experienced what we call a death spiral in a matter of days. Of course, if we look at how markets have been this year, they've been also very volatile. But the crash in the crypto world has hit many of the investors very hard, especially those who have had exposure in those stable coins. At iFAST, we've been sharing with investors of the dangers of investing in cryptos for quite a while. So sometime last year in June 2021, we presented our case to investors on why we think cryptos should be avoided for investors. In January this year, when we had our What and Where to Invest in 2022 event, we also talked about why cryptocurrencies are not an eternal or evergreen investment strategy. Basically, our view is that it's a speculative investment class, if we can even call it an investment class. So let's look at the performance of the various cryptocurrencies as well as the stable coins and just compare it with the S&P 500. So Jingyan, we have a couple of charts here. So as you can see, our audience can probably see the S&P 500, which is a proxy for the US market. That's of course declined almost 20% so far from that period that we're looking at, which is around November of last year. And that's around the peak of for most of the cryptocurrencies. So Jingyan, what's your view on what's been happening in the crypto world?
Yeah, so as much as the equity itself has been quite painful, 20% is no small sum for many of us. It's been much worse in the crypto space. Even the big established ones, Bitcoin, Ethereum, which are bigger than the rest of the crypto market combined, they're down 56, 58%. And this is probably largely due to rising rates, as well as just the end of a lot of the speculative fervor that has plagued markets for maybe since March 2020 as a rough example. So I think after March 21, after the whole GameStop saga where the speculative fervor sort of peaked, we have started to see some of, I would like to say, rationality returning to markets. And so after November, as the tightening became very clear, inflation seemed out of control and still kind of does actually. So as tightening started, and then we started to see most of the crypto space start to sell off. And also it has been relatively correlated. The space is very correlated. And Terra USD and Luna shook markets because of how big it was, how fast it blew up, and how badly it blew up. As you can see, Luna, 99%.
Yeah, it's really a dramatic turn of events in a matter of just days, because we're talking about Luna and Terra, the so-called more popular stable coins. And stable coins were positioned by the supporters of cryptos as the more stable items, right, or options in the crypto world, as opposed to, let's say, your Bitcoin or your Cardano and so on. But that has not proven to be true, as we have seen. And maybe we'll just go a bit deeper into what has really happened in those stable coins and try to understand what's next, what led to that, and so on. So, Jingyan, I'm going to ask you again, for Luna and Terra, what really happened and transpired in the last few weeks?
Well, basically, Luna and Terra are a pair of sister cryptocurrencies, and they are known as algorithmic stablecoins, which sounds complicated and has the word stable, but the stable, as it has shown, is largely a misnomer. It's not really actually that stable. So how it works is that you promise that people can always exchange 1 Terra USD for $1 USD worth of Luna. And if Luna is trading at 10 cents, then you will get 10 Luna. If Luna is trading at if Luna is trading at 10 cents, you'll get 10 Luna. If Luna is trading at $20, then you'll get 0.05 Luna. So it's just a very simple relationship. The price of Luna is arbitrary, and this relationship works as long as Luna is worth anything greater than 0. Right? And in addition, Terra should always trade at $1, and this is controlled by varying the supply of Terra via its relationship with Luna. So if it trades above $1, you can sell Terra for more than $1. And then you could use Luna to buy Terra at more than $1. If it trades below $1, then you can buy Terra for less than $1 and sell it for $1, making an instant profit. So in traditional financial markets, this is known as arbitrage, right? So this works as long as the value of Luna is above 0. And this is a common symptom for many cryptocurrencies. It works on the basis that someone believes that it is worth more than 0. However, what happened is that the market decided that neither Luna nor Terra was worth anything. And that was because of something happening in the back, where originally the demand for Luna and Terra was created by something called the Anchor Protocol, where people could deposit their Terra coins for a 20% annual return, which sounds too good to be true and has proven to be too good to be true. So when this relationship broke down, when they couldn't offer this 20% anymore, and not just that, I think it was simply just speculation that they couldn't offer this 20% anymore, then people started selling both Luna and Terra. So what happens is that you can see Terra breaking its peg, and as Terra broke its peg, the algorithm started printing Luna in order to absorb the extra Terra demand. So Luna supply shot up. This is unfortunately is not a price chart. So Luna supply shot up from 343 million coins in circulation to 6.53 trillion coins in circulation, and the price simply doesn't hold up anymore. It's a massive share dilution. In traditional markets, if you convert a bond to shares and then they keep printing shares to absorb the bond demand, then the shares get diluted and the company is split over a larger number of shares, and each share is worth significantly less. So this is something that we have seen before in traditional financial markets. So this is called a death spiral, and unfortunately it's not practiced very much because of this.
Yeah, I think you can see that this so-called relationship was based on this algorithmic structure that I think the founder behind Luna and Terra, Do Kwon, came up with. I mean, in the crypto world, he is sometimes seen as quite a maverick, quite outspoken as well. But in a way, when we look at this, right, it's a bit like a run on the bank. And, there's like probably rumors circulating at the very beginning about, these so-called stable coins, or let's say some investments, which were supposed to be stable, which were supposed to be pegged to, let's say, a US dollar, or maybe other stuff like commodities. That relationship and that trust that it's going to stay stable and stay pegged, right, just broke down and just led to this massive outflux of investors just wanting to make a run for safety, because they're like worried that, hey, my investment in this is just going to disappear. And that essentially has happened to those investors, very unfortunately, who were exposed, who had, these stable coins, right, in their portfolios.
I think
the Asian financial crisis. Is there anything from a history book perspective in finance that also is interesting to highlight here?
Well, I don't know whether it's because of willful ignorance or hubris. I don't want to accuse anyone of either, but the whole reason why the banking sector is as regulated as it is because it has been built on the blood of previous financial crises. And the crypto markets could look at this and probably learn something from it. So I think you mentioned the Asian financial crisis. So in 1997, basically there were a bunch of Asian currencies, the Thai baht, the Korean won, they were all pegged to the US dollar. But now very famous investor, George Soros, right? Everyone kind of knows him. Everyone in finance kind of knows him. So decided that they couldn't hold this peg. They didn't have enough money in reserves to hold this peg. And so he tested them. And turns out they couldn't. And this loss of confidence led to the peg breaking. If you look at currency charts, they end up looking something like this. Not much different. And eventually, all the pegs broke and we suffered a multi-year financial crisis. The AFC were quite bad for the younger investors who can speak to their parents. I'm sure the parents know as well. And even that had precedence. So in 1992, George Soros did the same thing, and not with emerging market currencies like the Thai baht, the Korean won. He did this with the British pound. And back then, the British pound was pegged to the Deutschmark before the euro was invented. Similarly, they couldn't withhold high interest rates in the UK. And then when George Soros tested the system, it broke. And again, the chart looks almost identical to this. And also, there are lessons to be learned from the 2008 GFC, because this sort of structure where the value of an asset is dependent on itself, sort of a self-perpetuating cycle, and assets being disguised as safer assets than they actually are, that house of cards structure is also what caused the runs on the mortgage-based securities, or that in 2008, which caused the GFC. So history is littered with lessons. It's just whether you want to pay attention to them or not.
Yes, I think it's very true that there are episodes in the past that sometimes get forgotten in the history books. And I think in the case of cryptos, one of the things or the flaws that we highlighted to investors is the fact that there is no intrinsic value behind the cryptos. That was a major issue because when you look at the investment world, whether you look at a stock or a bond and even other alternative investment asset classes, there is something that you can measure in terms of its future potential, whether it's its income, its earnings growth, based on the business model and so on, right? And you can then also say whether it's trading at an expensive value or a cheap value because of how the prices of, let's say, the stocks have been moving. But not so much in the crypto world, because there isn't that intrinsic value, and it's very much based on speculation that this is the new hot thing that everyone should have an exposure to. I think this kind of way of looking at it during times when there's a plentiful money supply, when there's ebullient investor sentiment. You mentioned rationality. So in many ways, there was irrational exuberance in the last couple of years in the crypto world. When that comes crashing down, and very fast at that, then I think that's when we realize it's really not so straightforward, right? And I just wanted to bring up the history books, or at least people who are veterans in the investment world. So in this case, Warren Buffett and Charlie Munger, for example. And I think they just had their Berkshire annual general meeting in April. And I think they didn't mince their words. I think Charlie Munger was saying that he sees generally cryptos to be an evil kind of thing because of the various reasons that are stated, including the lack of intrinsic value and so on. Actually, when we look at whether crypto deserves a place in an investor's portfolio, starting from last year at iFAST, we've been also highlighting the risks, the flaws of cryptos, and that it does not deserve a place in our investment portfolio if we are serious about wanting to invest to achieve certain goals in life, whether it's retirement, recurring income during our retirement days, whether it's to have enough funds for our children's education and so on, right? And therefore, crypto is purely speculative or similar to gambling. And I think when we look at recent comments because of what has happened in the crypto world, then you see a bit more of these voices coming out louder. I think the Christine Lagarde as well, the ECB, has been saying that she has no way of measuring it, right? Cryptos, I mean. So I think there could be more warnings that could come out louder. Simply because I guess the proponents and supporters of cryptos are now also trying to regroup and rethink what's been happening at their side. So just moving on to this topic of cryptos and investors previously at least saying that it could be a good inflation hedge, and therefore it deserves a place in investors' portfolio. I think in many ways, that was one of the arguments put forward by the crypto supporters, something that we don't agree. What's your view on this, Jingyan? How would you tackle it when investors come to you with this, with this point?
I mean, I think the charts speak for themselves. So the fact that the idea that cryptos are an inflation hedge has been proven wrong this year. Inflation has been on a tear, but Bitcoin has not moved like an inflation hedge. It has moved like a tech stock. So as I prepared a chart here, Bitcoin has moved. This is the Nasdaq next gen index. So these are tech stocks that are not included in the Nasdaq, the largest 100 tech stocks on the Nasdaq. And the story speaks for itself. It has gone down. In fact, Bitcoin has proven to be even more volatile than these more unprofitable tech stocks. And if we do a correlation analysis, how closely does it move to the Nasdaq Next Gen Index, you come to a correlation of 0.65, which is I would say it's very high. It trades like a tech stock. It behaves like a tech stock because it is essentially investing in the potential, the future of blockchain technology. And right now, there are still no fixed applications for it. There's no one big use for it. And people are still speculating, trying to decide. It's like a solution looking for a problem to solve, right? And people are just investing in the potential of it. And this potential doesn't even have a road to profitability. Like when you invest in a new young tech company, you're investing in it with the hope that, or with the belief, I would say, that one day, maybe it might be in the far future, 20 years from now, where they make money and they'll be able to return some money to you, whether it's through share buybacks or dividends, the two traditional ways. How does a cryptocurrency achieve this? Nobody knows quite yet because it's still relatively new. And the only way is that someone buys it from you at a higher price. So that is very similar to the greater fools theory that we've been speaking about also.
Yeah, I think just to pursue that point about cryptos, right, and what's been driving it before the recent crash that we have seen. A lot of money circulating because of the easy monetary policies that your central banks in the US and even in Europe and so on have been adopting, right? Because they wanted to ensure that the economies are still growing, consumers are still spending, especially in the wake of the start of the pandemic crisis. And of course, now what we see is that there are inflationary risks because too much money, right? Chasing maybe too few goods. In this case, too few investments, and including crypto. That's why it shot up. But if you look at the global M2 money supply, this chart that you have here, you're essentially saying that the end of monetary policy is coming, and therefore that's not looking good too for cryptos.
So global M2, which is global money supply, peaked in February 2021, and Bitcoin's total market cap peaked in March 2021. I don't think this is a coincidence. I think that this illustrates the point that people couldn't find anywhere to put their money, and so they put it in speculative assets. And now, with inflation being a problem, global money supply is shrinking. This is where you see the crypto space shrinking and people starting to look for safer haven, more traditional assets that can provide you a more stable return and don't rely on people who have too much money to spend to buy things from you.
Yeah. Yeah, you have a point here about Bitcoin likely viewed as an extension of blockchain technology. And I think it's important to just bring up this point that blockchain could provide a lot of useful solutions, whether it's in the settlement of, let's say, different types of payments, or even in other industries. And maybe the mistake that maybe some of us make is to take Bitcoin as a proxy for blockchain. That would be a mistake because it isn't. And blockchain could continue to develop, continue to progress, continue to show perhaps important uses, but it does not mean that it's going to be the same for Bitcoin. So that in that sense, there's no perfect correlation between Bitcoin and your blockchain. And I also wanted to bring up this point because I remember at the start of this year when we had the Why and Where to Invest event for our investors, and we were saying that we don't believe cryptos will be an evergreen investment strategy for investors. So please avoid cryptos. One of the questions our investors asked was, why do you say that when global financial institutions are actually looking to promote crypto trading on a larger scale, including for retail investors? And our answer was simply that, even maybe big financial institutions have the fear of missing out. They also have FOMO, because when they see cryptos shooting up, in the last 2 years before the crash, and so many retail investors also wanting to have a slice of that crypto right, there's also FOMO at the institutional side. But it doesn't mean financial institutions want to promote crypto is a good thing for retail investors. Our view is that, in fact, crypto is not a good thing for retail investors because of all the risks that we have highlighted. And our view has not changed. In fact, in many ways, we want to continue highlighting the risks of being exposed to cryptos. And of course, when it comes to digital currencies, I think the other mistake that some of us hear is, everything is getting more digital, and that should also apply to, let's say, your digital currencies, and therefore your cryptos are a good proxy of that. But again, I think we would like to highlight that when it comes to digital currencies, there are indeed trends or developments that are promoted by central banks. In fact, what some central banks call this development is your central bank digital currencies. So some of the central banks in the world are already looking into ways to promote central bank digital currencies, or what you call your CBDCs, right? And they're looking at how to make use of it in, let's say, the wholesale CBDCs world. So maybe settlement or payment for transactions for certain investments. I think some of the central banks in Europe have already adopted pilot projects for that. So those are actual things that are already happening. And it doesn't mean that there's nothing that is progressing in the so-called digital currency world. There are things happening already. Even for, I think, the local regulator here in Singapore, they've been looking into various projects, whether it's in the wholesale CBCDs, or even for retail. They've been looking at whether there's a possibility to make retail central bank digital currency viable in future. It's something they haven't, of course, decided whether they will, but it's something they're looking at. So I would say that when you have central banks or government or authorities looking into that, there's certain reassurance that there's a framework that that is in a way parallel to what is already in existence in the money world, in the money physical world that we're used to, or even in the so-called digital payment world, like our PayNow and so on, right? Yes. That we're used to having, right? So that's how I will look at the argument about, there's nothing going on in the digital currency world. Yeah. I guess you have anything you'd like to add to this point?
I think it would be ridiculous to assume that a country would give up control of its currency to maybe, put it on the blockchain for everyone to see. Two big reasons for that. I think currency control is a very big part of monetary policy, and I don't see any country that already has the power to control its monetary policy giving it up to the whims of investors. Or I'm sure Asian financial crisis, again, it comes to mind. What happens when countries lose control of it? And secondly, I think countries have a very big incentive to control crime, and financial crime or payments for non-financial crime. Like, for example, the Colonial Pipeline hack was paid for in Bitcoin. And I think countries have a very big incentive to prevent this kind of crimes from happening, not just the disruption, tax avoidance, all factors that they have to consider. And I think you mentioned many countries just now, but the leader in central bank digital currencies is China. And as authoritarian as they are, I don't see it happening. And in fact, many of these CBDCs don't even rely on blockchain technology because of its limitations, mainly high energy expenditure, as well as how slow or how limited the number of transactions can be. Bitcoin does 5 to 7 transactions per second, and compared to Visa or Mastercard's 10 to 15,000 limit. And if countries or the entire world is using this, then it's a very big limitation if you can't transact immediately. So rather than investing in cryptocurrencies as a proxy to investing in central bank digital currencies, in fact, I don't think there is any way that you get this pure play exposure to central bank digital currencies. In fact, I think the technology is already much ready, and development and implementation is very much already underway.
Yeah. Let's wrap up with, let's say, the this other topic that we've been hearing from our investors as well, because markets have been volatile, and in some of the discussions we've had, we usually will say certain investments have fallen quite a bit, but because of its earnings potential and its valuation at this point compared to the past, compared to its peers, is looking quite cheap. So maybe if you are looking to invest for the long term, you can buy on dips, right? Unfortunately, we also hear that in the crypto world, buy on dips because crypto prices have dropped. And we would like to strongly encourage investors not to buy on dips in cryptos, or for that matter, to even buy cryptos if they are serious about, let's say, planning their hard-earned money for retirement purposes and so on. But just to wrap up as well, asset allocation, equities and bonds, how much to have, right? I think there's been a lot of negative news as well because of the fact that markets have fallen year to date. But our belief is that there are still merits, and it's been shown in the past that there are still merits in having an asset allocation that is diversified across equities and bonds. And within equities, there are different equities to look at. Same goes for bonds as well. So looking at the 60-40 asset allocation just as a reference point, and because there have been negative criticisms of that too in some literature recently, right? Yes. What's your view, Jingyan, on this?
I saw a report on Bloomberg earlier this week how the 60-40 is having its worst year on record since 2008. But even then, the worst year on record outperforms cryptocurrency by a good 30%, maybe. As much as technology is very much like exciting and interesting, sometimes the traditional route wins. And there's a reason why asset allocation is such a big part of investing, and why it's been harped on for so many years, since probably the beginning of time, maybe. Yeah, so the depth has been greatly exaggerated, and we yet again want to reiterate the importance of having a diversified portfolio that can weather all market conditions, and also give you the opportunity to bounce back when markets eventually pick back up. So I think throughout our events, our videos, we have shared plenty of investment ideas. In the second half of 2022, the same ideas that we have been harping on for most of second half of last year as well as this year remain. We like value, we like quality, and unfortunately, cryptocurrencies are neither of the two. Yeah.
Yes, I agree. So I think in moments like today, where markets are extremely volatile, where investors are probably concerned about the outlook for inflation, it's affecting quite many countries. China is an exception, but it also affects us here in terms of our daily expenses, right? What do we do for our portfolio? What can we do as inflation hedge ideas? So those are some of the topics we've been tackling, I think, in the last few weeks. And there will be more programs on iFAST TV from our analysts and our guests talking about how we can protect our portfolio in such times, how to supercharge it if we have a longer time horizon. In the shorter term, yes, things are volatile. And what are the various strategies? We said, you can dollar cost average. Perhaps that's one way to just, gradually enter and lower the cost of investing for some of your favorite investments. And also, of course, today's episode was really highlighting the dangers again of cryptos, and not to really avoid it when it comes to having something like that with no intrinsic value in our portfolios. Yeah. So happy to chit chat with you
Yes.
on this topic, and thank you so much for your time.